The subject of this video is fixed coupon equity preferred stocks, a frequent topic of my blog that I started in October 2008. As a conservative investor, I view these securities as a disfavored niche asset category for me. For fixed coupon equity preferred stocks, my general rule is that I want at least a 3% spread at my purchase price over the 10-year Treasury note yield as compensation for the risk of that are inherent in the equity preferred stock. I will sometimes require more based on my assessment of the credit risk. I currently own one equity preferred stock that has almost a 8% spread to the current 10-year Treasury yield, but have limited my exposure to just 50 shares as another way to mitigate the risk of that one. The disfavored status for me is in part due to these stocks being equity capital, junior in the capital structure to all bonds, but importantly, this is important, do not represent an ownership interest in the business, which is the most important characteristic of equity capital, which is present in the common shares, but not in the preferred shares. I view the preferred stock as combining the worst features of equity capital and bonds without the benefits provided by common share equity or senior unsecured debt. The fixed coupon preferred stocks are more bond-like, but lack the protection of bonds due to their lowly status in the capital structure and other characteristics that they have. Almost all preferred stocks are perpetual, meaning that they have no maturity dates. There are a few exceptions. A feature of individual senior secured bonds or senior bonds that I like is the promise to pay par value at maturity. Assuming no bankruptcy, I know when I buy the bond what my total return will be to maturity, to the penny, a sum certain, based on my purchase price. While potentially perpetual, the preferred stock generally has a limited call protection, which can, under certain circumstances, mean that the interest rate risk of these issues are asymmetric in favor of the issuer. Most preferred stock prospectuses will allow the issuer to call at par value 5 years after the IPO, which it will do only when it is in its interest to do so, not in your interest, since this happens only when rates have fallen sufficiently that the issuer benefits by calling the preferred stock, taking it away from you, leaving you with the proceeds that can only be reinvested in a similar issue with the same credit rating at a lower yield, and then go about and issue a new preferred stock with a much lower coupon. This has happened to me repeatedly over the period of low interest rates. Preferred stock dividend payments can be eliminated for non-cumulative preferred stocks or deferred for cumulative preferred issues, both with a legal impediment called the stopper clause, which enforces the preferred shareholder's superior claim to cash compared only to the common shareholder as a legal matter. Generally, a preferred dividend has to be paid under the typical stopper clause when a cash dividend is paid on the common shares or cash is used to buy common stock. However, once that legal impediment is removed because no cash is used for those purposes, no legal impediment exists that would prevent a company from eliminating the preferred non-cumulative dividend or deferring payment of the cumulative preferred dividend. The dividend in both examples may still be paid, but the issuer, if they're eliminating the common share dividend, is not exactly in the best of shape and is doing so in order to preserve capital. The owner is clearly in an enhanced danger of losing the dividend payment when the stopper clause is no longer prevents deferral or elimination, which is, after all, the only reason why an investor would buy a preferred stock rather than a common. The issuer of a senior unsecured bond has no option to defer or eliminate interest payments unless the company wants to end up in bankruptcy court. The downside risk of all equity preferred stocks is a zero stock price in bankruptcy. That will almost invariably happen with preferred stocks issued by bank holding companies. When and if the FDI seizes the operating bank, the remaining assets at the bank holding company level will be substantially lower in value than the outstanding senior debt. I think it was in 2022, there were a number of bank failures caused by deposit runs on the operating bank. And at least two of those banks had preferred stocks outstanding that became worthless when the bank holding company declared bankruptcy. Dividends paid by preferred stocks may be qualified or non-qualified. Qualified dividends for U.S. taxpayers are taxed in the same manner as common share dividends, meaning that there is a cap on the maximum tax payable. Preferred stocks issued by bank holding companies are generally qualified and non-cumulative, which simply means that the payments can be eliminated once there is no legal impediment provided by the stopper clause. Preferred dividends paid by pass-through entities where no tax is paid at the corporate level, an example is REITs, will generally be non-qualified or almost entirely so. Most REITs will own assets that exceed debt outstanding, so a preferred stock issued by them, at least the equity REITs as opposed to the mortgage REITs, would probably have some value in a bankruptcy, but that depends on how much debt was added during the period of financial stress that led to the equity REIT bankruptcy filing and whether the economy is or is not in dire financial straits when the bankruptcy is filed. Many of the REIT's preferred stocks will support part or some of the dividend payments from return of capital, which I will simply abbreviate to ROC, R-O-C, meaning that some part or even all in some cases of the dividend was not covered by GAAP, generally accepted accounting principles, reported earnings. That part of the dividend source from ROC reduces the tax cost basis of the shares for U.S. taxpayers and is not taxed until the shares are sold at a profit based on the adjusted tax cost basis. There is consequently a potential to turn what would have been taxed as ordinary income equity REIT dividend into a long-term capital gain. And if there's no change in the current tax law, that allows a deceased estate to step up the tax cost basis to market value, which is the current law, as of the date of death, sometimes later. Then no one pays tax on the difference between the lowered tax cost basis resulting from the ROC adjustments and the fair market value at the date of death. That could have some benefit from a tax viewpoint, not for me, and I own equity REITs, but for my heirs. Still, in my lifetime, I would want to have a REIT stock produce a total return in excess of the dividend payments prior to ROC adjustments to the tax cost basis. For some REIT stocks, the decline in market value of the stock has wiped out the value of dividend payments, and that is not a desirable outcome for me or anyone that's living, in my opinion. If the tax cost basis had been reduced to zero and no lower for from rocket adjustments, there's no value to me in owning a preferred stock that pays 6% and goes down in price at an average annual rate of 2%, as an example.